Nick's gonna start doing these meetup meetings once a month. And we'll start kind of today. A couple of you have been through the process, but let me take you through the four total components of total return first. First, cash on cash. So when you're look at make an investment, we'll do a couple of case studies before we get out of here tonight. Cash on cash is the return after all expenses that you get on your investment. Let's say you buy a $500,000 home for 20% down or 100,000 down. You have a $400,000 mortgage. So after the debt service on the mortgage and all of the operating expenses are deducted, and we're going to take you through a quick shortcut to figure out whether a property is worth looking at or not. Okay? Because when you underwrite properties, it takes time. And if you can come up with shortcuts, which I'm going to give you tonight, nobody else. And at one time, owned 13,000 apartments. 13,000. 13,000. And 1031 exchanged them in the early 2000s into 18 million square feet of industrial space in big boxes. Okay. With 700 tenants, 18 million square feet. If you haven't figured out how much that is divided by 43,560, then it's about 400 acres. I saw the downturn coming in 2008, and I thought I wanted my investment capital invested in lower rent areas that were not going to suffer as much with the real estate downturn that we had in 2008. And I thought it was coming, and it did. So when we took them and sold them and 1031 them into big boxes, and did very well, made a lot of money. So anyway, the second component of total return is principal paydown, and that's the mortgage amortization you have each month and each year. And oftentimes, principal paydown will kind of equal cash on cash. No relationship, but oftentimes when you do the numbers, principal paydown will equal cash on cash return. The third component of total return is appreciation. For the last 37 years in Massachusetts, residential and multifamily properties have appreciated 7% a year, with only two down years, 1990 and 2008. And the 7% includes those two down years. So think about this. If you put 20% down on a property and it appreciates 7% a year, that's 35% return on that 20% down. So appreciation is a big component of total return. And the last component of total return is tax gain or loss. And in Trump's big tax bill, he reinstated cost segregated depreciation, which means that you can take all of the components of a property, plumbing, electrical, lighting, cabinetry, things that you would normally depreciate in 7 years, and write them off in 1. So it's not unusual to buy a property and get 30% first year depreciation. So if you buy a $500,000 property and you do cost segregated depreciation, you get $150,000 write-off in year one. So it saves lots of taxes. And when it saves the taxes, it's like putting money in your pocket. And you can figure in Massachusetts, 42% in the top bracket. In the federal tax laws, a residential property, multifamily, can be depreciated in 27 years. A commercial property, a big industrial building, can be depreciated in 39 and a half years. Plus the cost segregated depreciation. So take $1 million building and say the land is worth $200,000. You cannot depreciate land. You can only depreciate the building. So you have $800,000 left to depreciate. And if it's 39 and a half years, figure 40 years. So you can take $800,000 and write it off over 40 years, $20,000 in depreciation a year, directly against your taxes.
The biggest problem, my wife does taxes. She's an enrolled agent with the IRS. She does about 550 returns. And she found most of the people in my real estate investors weren't careful on the depreciation. So if you have a roof done and that has to be written off 27 years.
Yep.
Okay, it's kind of hard to control yourself to only write off 1/27th of that roof per year. Let's keep track of it. So people will inevitably try and write off the whole thing. Now, if it's a repair, that's legit, you're okay. But if it's a replacement, you try and write it off as a repair. It's not going to happen. Same thing with boilers and stuff that's pretty common for us.
Depreciation is included as an expense as you take your total deductions for expenses. Okay, so 4 components: cash on cash, principal pay down, appreciation, and tax gain or loss. So when you look at a real estate investment, you've got to add those 4 components together to figure out what your total return should be. My personal guideline for years has always been 20% total return a year. Okay, just to give you a guideline. If I can't get 20%, I don't want to invest in it.
You're treating cash flow separately. That's a separate.
Cash flows are part of the 20%. Okay. Yeah.
How would you judge how much appreciation to put? Would you just use 7% as your average per year?
Depends on where the property is, what town it's located in, and I'd look at the market statistics in that town. But as a general rule in Massachusetts, you can use 7% because that's what it's been for 37 years. Pretty good.
Yeah.
I mean, pretty good barometer. Okay. So once you understand total return, that's the first step in assessing whether you want to invest in a piece of real estate. Okay. So I'm going to give you a shorthand method now to evaluate properties. A 4-family in North Andover, for argument's sake. Okay. And the property's worth $1 million because it has 80,000 in net operating income after all expenses. $1 million at an 8 cap, because cap rate is determined by how much net income, NOI, net operating income, you can get on an investment if you pay cash. Paying cash is the key. Okay? Because with a cash investment, you establish the cap rate. Now, a quick and dirty rule I'm going to give you, which you'll use 1 million times if you decide to invest in real estate, is that to buy to buy a multifamily or a commercial property, you need a cap rate of a minimum of 1 point over the rate you can borrow the mortgage for a local bank. So if you can borrow today, the rate for a multifamily property that's cash flowing is 6%. That's what the bank's going to charge you an interest rate. So you can afford to buy a property at a 7 cap. Doesn't mean you wouldn't like to have an 8 cap or a 9 cap, but a 7 cap will cash flow. And a 7 cap will cash flow at about a 5 or 6% cash on cash return. Okay? So let's take a look at that property. And $1 million property for a 4-family. And the cash flow is $80,000 a year before debt service. If you put 25% down, that's $250,000. So that means you've got to borrow $750,000. Let's just say a 30-year loan at 6% for $750,000. The monthly payment is $44.96. So let's say $44.96 times 12. So that's $54,000, $53,959, 54. And how much did this property throw off? 80,000, right? So it threw off 80,000 minus 80,000. So that throws off 26,040 cash on cash. Divided by 250, 10% cash on cash. Pretty damn good. Would you take 10% cash on cash? I'd buy 5,000 apartments today at that. Because they aren't there. You can't find them. 10% on my 250,000 investment. But I'm paying down principal, aren't I? So I probably have another 20,000 in principal pay down or thereabouts. I can calculate it and give it to you, but let's just assume 20,000. Okay. And I've got 25,000 in cash on cash. So my return now is 45,000. And what else have I got for total return? Appreciation. But what have we got? We've got 25,000 cash on cash, 20,000 in principal pay down. How much appreciation do we have?
7%.
70,000. So now you have 70,000 in appreciation, 20,000 in principal pay down, and 25,000 in cash on cash. So you have $115,000 on your $250,000 investment. But let's say you're making a lot of money. $500,000 a year, $400,000 a year, $300,000 a year, and you do cost segregated depreciation, and you get another 30,000 in tax deductions for that. So at 400,000, you were going to pay 150,000 in taxes, but with a $300,000 deduction, you don't pay 150,000 in taxes. You pay 30,000 in taxes. So there's another 120, and that's how this whole real estate game works, and it works every time, providing you make the right investment up front. Now, hard to find an 8 cap property, but you can find a 7 cap property. And a 7 cap property won't give you 25,000 in cash on cash, they'll probably give you 10 or 12. Okay? So you still have the same principal pay down, you still have the same appreciation. You still have the same tax gain, you just have less cash on cash coming. Let me share a story with you. In 1969, before most of you were born, I owed the First National Bank of Chicago $350 million and Travelers Insurance Company $275 million, which was a lot of money back in those days, with no personal guarantees, secured by the assets we had in the operation. We had the largest cattle operation in America and owned 4 million acres. Produced 5% of all the beef that was eaten in America. I started the Certified Angus Beef program. So bottom line is, had I not had that debt, I would not be in the position I'm in today. But Mr. Carter, Jimmy Carter, and Joe Biden had the same reaction at the same time, 60 years apart. And that is that my interest rate at the First National Bank of Chicago, my interest payment went from 25 million a year to 130 million a year in 12 months. Because we had interest rates go from 5% to 21%. So that was inflation like we haven't seen it until Biden put us through the same process 5 years ago down to a year. Okay? Questions or thoughts? All right, I'm going to teach you now how to assess a property. So let's say you look at the multi-list, or you look at Crexy, or you look at LoopNet, okay, or you look at CoStar. Those are all places where commercial properties are advertised. Okay.
What's the CoStar?
CoStar, LoopNet, Crexy, CREXI, and the MLS system are the primary dispensers of commercial property information. And let's say you look at on LoopNet and you see a 4-family listed for $1 million. We'll keep going back to that $1 million property. So here's the formula, and write it down, and it'll save you thousands of hours if you become a real estate investor. Take the gross rents and multiply them times 95%. That gives you the net rents. And that tells you that your apartments are not going to be 100% full all the time. You're going to have some vacancies. And that says that each apartment in your building is vacant 1 month out of 20. Get that in your head, 1 month out of 20. That's a pretty well-run apartment complex or multifamily operation. When we had 13,000 apartments, for 7 years, we averaged 97.2% full. And let me tell you what, that was really hustling. When we asked people to give us notice 4 months before they were going to move out. So that we knew when we had to bring a new tenant in, and we could line them up, and we turned them over in 2 days from one apartment to the next. So that was a really pretty well-run apartment complex. So now the first part of the formula is gross rents times 95% for net rent. If it's a 2-family or a single family, take another 10% off of the rental income. If it's a true multifamily, take 20% off of the rental income in both cases after you've deducted the property taxes. So property taxes first expense, 10% if it's a 1 or 2 family, 20% if it's a multifamily. And that gives you a net operating income number. Then you divide that number by the percentage cap rate you want to have when you buy the property. And if it's today, the minimum I'd have, if the bank rate is 6%, I told you I'd add 1% for cap rate, didn't I? So I'd divide that number by 0.07, and that'll give me the value of what I can afford to pay for the property. I know whether that property is worth going to look at or isn't. This tells you in 3 minutes or 4 minutes whether that property is interesting enough to go look at or not. Okay? And so you're not wasting time. I can't tell you how many thousand investors I've had call me and say, Bob, I want to go look at 123 Smith Street. And I know the minute I talk to them that 123 Smith Street's overpriced and isn't going to cash flow. And I look at how much it's overpriced to see whether it's worth going to show them the property or not. Because if I've got to negotiate the price 25%, it's not worth bothering. Very first apartment complex I bought in Ypsilanti, Michigan, 302 units. And when I went to list it, and the guy who owned it was a Baptist minister who built it, 302 units, and he had another 1,400 units that he owned. He decided he wanted to sell this 302 units. When I looked at the rent roll and did an analysis, he and I looked at the numbers, and I told him I thought I could get $6 million. And he said, if you can get that, I want to list it with you and let you sell it, Bob. I said, okay. So I said, I need a rent roll. And so he got me the rent roll, and I looked at the rent roll, and 270 of the 300 apartments, tenants, had been there for an average of 7 years. And the apartments were renting for $4.25. Okay, this was a long time ago. 600 square feet apartments, hardwood floors, ceramic baths, ceramic kitchens, ranch units. Can you imagine 300? It was like an army barracks, 302 ranch units lined up. It's like an army barracks. When I looked at the rent rolls, his name was Morris Anderson. I said, Morris, would it offend you if I bought this property from you? He said, no, I'd love to sell it to you, Bob. So my commission was 10%. That was $660,000. That was a pretty good down payment. And I bought it, and we closed on it. And within all of his tenants were also month to month. Another great lesson, because if they're on annual leases, you can't raise the rents till the end of their lease. Make sense? They were all on month to month. In the first 2 years, we raised the rents 5 times. And a lot of people moved out, but they moved in because the rents are still affordable. And within 2 years, I had the rents from $4.25 to $6.50. And that property printed money for 25 years after. Just printed money. Every month it was like it going to a cash machine and taking out the cash. It's incredible. So it's within 12 years, we had 13,000 apartments, largely because we made a great buy on the first ones we bought. So the bank said, Jesus, you're killing it. We'll loan you a lot more money, and they did. So the sources for identifying properties are CoStar, LoopNet, Crexi, the MLS system, and there's 2 or 3 others, but they're much less significant than those 4. All right, guys, thanks for coming. And fill the thing out for Nick, put your name and email and phone number, please.